When most people first hear the word stock, they imagine a blinking screen. They imagine green arrows, red arrows, a ticker symbol, a phone app, a commentator on television, and a crowd of men in jackets pretending that shouting is a form of wisdom. That is not how I think about stocks. That is how people think when they have not yet understood what a company actually is. And until you understand that, the rest of the stock market will always feel more mysterious than it really is. So I want to take you somewhere simpler. Forget Wall Street for a moment. Forget CNBC. Forget the daily price. Forget what your neighbor said about some stock he bought on a Thursday and sold on a Monday and now wants to call investing. Let us begin with the company itself. A company is a basket. That is all, a basket full of valuable things. Some of those things are tangible. You can touch them: trucks, factories, buildings, machines, inventory, cash in the bank, office furniture, a server farm, a warehouse full of products waiting to be sold. Those things are easy for people to see because physical things feel real. But some of the most valuable things inside the basket are not the things you can touch. A brand, a reputation, a loyal customer base, a software ecosystem, a distribution network, a culture of efficiency, a patent portfolio, a set of habits in the consumer mind, a place in the public imagination that no competitor can easily buy. Those things matter just as much and often much more. Take Apple. Yes, Apple has warehouses, it has chips, screens, assembly agreements, cash, stores, data centers, and all the usual tangible assets of a giant enterprise. But if you think Apple is mainly boxes full of phones, you do not yet understand what makes Apple valuable. The deeper magic is that millions of people are not merely buying a phone. They are buying trust. They are buying familiarity. They are buying belonging. They are buying a little slice of identity. They are buying a system that makes switching feel costly, even when no one says the word cost aloud. That is why a company can own enormous value in things that accountants struggle to describe gracefully on a balance sheet. So when I tell you to think of a company as a basket, I am not being cute. I am trying to give you the most useful mental model in all of investing, because once you can see the basket, you can begin asking the right question: who owns it and how is that ownership divided? That is where stocks and bonds enter the story. Now let me make this as plain as I can. Imagine you are a carpenter, a good one. You know how to build things, you know how to fix things. You know how to turn wood, tools, and labor into work people will gladly pay for. You have $10,000 saved. That is something, but not enough to build the operation you want. You need a truck, you need tools, maybe a small workspace, maybe better equipment so you can take larger jobs. So you go to your friend Jake and say, "Lend me $10,000 and I will pay you back in a year with 5% interest." Jake agrees. Now you have $20,000, you buy the truck, you buy the tools, you start working. A year later, let us say you have built something real. You made $50,000 in profit and you still own the truck and the tools. Now here comes the moment most people vaguely understand but have never truly internalized. How do you divide that result between you and Jake? Jake lent you money. He did not become your partner. He does not own your future upside. He does not get to say, "Since the business did wonderfully, I should get half the gain." Number Jake gets what was promised, his $10,000 back plus 5% interest. That is it. That is what a lender is. He gets paid first, but he gets only the fixed terms he accepted. You, on the other hand, are the owner. After Jake is paid, everything left belongs to you. The truck is yours, the tools are yours, the ongoing business is yours, the extra profit beyond the promise is yours. That is the difference between debt and equity. A bond is debt, a stock is equity. A bond says, "Give me money now, and I will return your money later with a defined amount of interest." A stock says, "Give me money now, and you will own a piece of whatever this basket becomes." Those are radically different promises. The lender gets contractual certainty, at least in principle, but limited upside. The owner gets uncertain outcomes. But unlimited upside if the business thrives. And that arrangement has consequences when things go badly too. Let us say your carpentry business fails, no big contracts, the truck breaks down, a recession hits, customers disappear, you lose money. Now what happens? The law of the capital structure remains the same. Jake still gets paid before you do. If there is value left in the truck, the tools, the receivables, the little pile of business leftovers, Jake's claim comes first. That is what debt means. The stockholder, meaning the owner, stands last in line. That is why stocks are riskier than bonds. The stockholder gets the whole feast if the feast is large, but he also bears the residual risk when the feast disappears. I have always liked this structure because it teaches you something much bigger than finance. The world often pays fixed claims first and uncertain greatness last. That is why ownership matters so much. Now let us move one step further. Your carpentry business does well. Not just decently, it really works. So well, in fact, that now you want to expand into nearby cities. You need more trucks, more tools, more crews, more systems, more working capital. You have a choice. You can borrow more that increases your debt burden, or you can sell pieces of the basket. You can invite in new owners. Maria buys in, Tom buys in, a few others buy in. They are not lenders like Jake. They are owners now. Just like you, the cash they give you goes into the company grows. That is the basic logic of selling stock. And the first time a company sells stock to the public, we call it an initial public offering, an IPO. Now people hear that term and think it means something grand and complicated. It can be grand, it is not conceptually complicated. It simply means the company is selling pieces of itself to outside owners for the first time in a public market. The company gets the money, the ownership base widens. That is the first transaction. But here is the part that confuses almost everyone at the beginning. After that first sale, most stock market activity has nothing to do with the company receiving new money. This is one of the most important things for a new investor to understand. Suppose Maria bought stock in your company at the IPO. A year later, she wants to sell. She sells to someone else. Who gets the money? Maria does. Not the company. The company got paid when it first issued the shares. After that, the shares simply change hands between investors. That is the secondary market. And that is what most people mean when they say the stock market. It is largely a giant marketplace where ownership claims pass from one person to another. It is like a used car market. Toyota gets paid when the new car is first sold. After that, the vehicle may be bought and sold 10 more times, but Toyota does not keep receiving checks each time the car changes hands. Stocks work the same way. Once the company has sold the shares into the world, people trade them among themselves. This matters because it clears up a lot of beginner confusion. People often ask, if I buy Apple stock today, does my money go to Apple? Usually no. Your money goes to the person selling you the Apple stock. You and that seller are exchanging ownership at a mutually agreed price. Apple itself is not standing there with a bucket collecting your cash every time two investors trade. Once people grasp that, the stock market starts making much more sense. Now we reach another question beginners ask. If the company does not receive my money most of the time, then why own the stock at all? The answer is simple. Because ownership can pay you in two ways. The first is capital appreciation. You buy a share at $50. Years later, someone is willing to pay $100. You sell, you doubled your money. The second is a dividend. Some companies generate more cash than they currently need and choose to send part of that excess cash back to owners. If you own 100 shares and the company pays $2 per share in dividends, $200 appears for you. That is real money distributed because you owned a piece of the basket. Not all companies do this. Amazon, for example, historically preferred to reinvest heavily in growth rather than distribute dividends. Coca-Cola has long been famous for paying a recurring dividend. Neither approach is automatically right or wrong. The real question is what creates the highest long-term value per share. A company that can reinvest retained earnings at wonderful rates of return should often keep the cash. A mature company with fewer high return reinvestment opportunities may sensibly distribute more. That is capital allocation. And capital allocation is one of the most underappreciated arts in business. Now, no matter which kind of company you own, dividend payer or non-dividend payer, there is one thing everyone keeps staring at. The price. Why does the price move? Supply and demand. That is the first answer and still the right one. If many people want to buy and relatively few want to sell, the price rises. If many want to sell and few want to buy, the price falls. That much sounds obvious, but then people ask the next question, why do people suddenly want to buy or sell? That is where the future enters. The stock market is not pricing the past. It is constantly trying, awkwardly and emotionally, to price expectations of the future. Apple announces a new product line people think will boost profits. More buyers appear. The price rises. A company reports weak earnings or hints that next year may disappoint. Sellers appear. The price falls. Sometimes the reaction is rational. Sometimes it is hysterical. Sometimes the market is a beautifully efficient weighing machine. Sometimes it is a wildly emotional voting machine. Usually it is some combination of both. That is why prices can move far more violently than the underlying business changes on any given day. The market is not only processing facts, it is processing feelings about facts. And human beings are emotional creatures. They panic together, they get greedy together, They tell themselves stories together. That is one reason I have always preferred looking at the business first and the market second. The market is there to serve you, not to instruct you every morning on what reality is worth. If you let daily price movements define your emotional state, you have turned investing into a nervous disorder. A stock becomes worth whatever someone will pay for it right now. That does not mean that is what the underlying business is truly worth. That is the gap where investing lies. Now, most people do not stop at understanding what a stock is. They want to know what to do. Should they try to pick winning companies? Should they trade around headlines? Should they predict whether Jerome Powell will raise or cut rates? Should they guess what the economy will do next quarter? Should they buy this exciting story or that fashionable sector? I have watched generations try to get rich that way. A few succeed. Many make their lives much harder than they need to. I have a simple view. If you do not love the work of analyzing businesses deeply, if you do not enjoy reading reports, comparing economics, judging management, studying capital allocation, and thinking independently for long periods, then you probably should not try to become a part-time stock picker in between normal life obligations. This is not an insult, it is liberation. Because there is something much easier and much better for most people. Buy a little piece of everything, own the broad market through a low-cost index fund. That one sentence has saved more people from financial self-harm than almost any other idea in investing. An index fund is simply a basket that owns many companies at once, sometimes hundreds, sometimes thousands. When you buy an S&P 500 index fund, you own a small piece of 500 of the largest public companies in America: Apple, Microsoft, Google, Amazon, Walmart, and hundreds more. You are no longer trying to identify the one future champion. You are buying the productive engine of American business as a whole. That is very powerful. It is also very boring. That is one reason it works. People undervalue boring because boring does not flatter the ego. No one is impressed at a dinner party when you say you steadily bought a low-cost broad market index fund for 20 years and then woke up wealthy. They are more impressed by some man who says he found a double in an obscure semiconductor name after reading a thread online. The quiet index fund investor usually ends up with more money and less stress. That is my kind of result. Over the last century, broad American equities have returned about 10% annually on average over long periods, with plenty of ugly years, frightening drawdowns, and uncomfortable stretches along the way. Your uploaded reference specifically points to the long-run record of the S&P 500 being up over decades and averaging around 10% annually over the long run, which is directionally the right starting point for a beginner mental model. Fay Felicite Fay turn 93 file 0 Fay. That average does not mean a straight line. Some years the market falls, some years it soars. Sometimes you feel brilliant for doing nothing, sometimes you feel idiotic for doing nothing. That is normal. The key is understanding what you own. You own a claim on a large group of productive enterprises operating in a dynamic economy. You are letting time, innovation, inflation pass through business adaptation and collective productive energy work on your behalf. That is much better than treating the market like a slot machine. There is a reason most professionals fail to beat the broad market consistently over long stretches. The market is a very difficult opponent once you subtract fees, taxes, emotions, timing mistakes, and the simple human desire to feel clever indexing sidesteps. Most of that, it says something refreshingly humble. I do not need to be the smartest person in the room. I simply need to own productive assets, keep costs low, keep adding, and not panic when the crowd does its periodic impression of insanity. That is a beautiful system. It makes wealth accessible to ordinary discipline. Now I want to say something important about patience, because index funds without patience are like engines without fuel. If you buy an index fund and then sell it because the market fell 20%, you did not own a long-term productive machine. You rented an emotional experience and reacted badly to it. The gains in broad market investing belong to the people who stay in the seat. That is why I always tell people not to judge a long-term asset by short-term discomfort. A farm can look silly in a bad season and still be a fine farm. A business can endure a recession and still be a fine business. The market can decline sharply and still be doing what markets have done across history. The person who panics in every storm never gets the benefit of sailing. You will notice something else if you study the broad market closely. The index itself is not static. This is another quiet advantage. The S&P 500 is not a museum of yesterday. As heroes, it is a rotating list of survivors. Weak companies fall out, stronger ones rise in. New leaders emerge, old names disappear. The index adapts without requiring you to guess the handoff in advance. That is a marvelous feature. It means you are not only betting on today's giants, you are betting on the ongoing ability of the American business ecosystem to produce future giants. That is a much safer bet than assuming any single company must remain dominant forever. Now let me come back to the beginning, because if you really understand all this, most of the fog around investing disappears. A company is a basket of valuable things, both visible and invisible. Bonds are fixed claims on that basket. Stocks are residual ownership of that basket. Bondholders get paid first, but only what they were promised. Stockholders get what is left, which means greater upside and greater risk. An IPO is the first public sale of those ownership pieces. After that, most stock trading happens between investors, not between investors and the company itself. Prices move because people buy and sell based on changing beliefs about the future. You make money through rising share prices, dividends, or both. And if you are just starting out, the most rational move for most people is not to hunt for the magical stock. It is to buy broad productive capitalism at low cost and let patience do the heavy lifting. That is the core. It is simple, it is not glamorous, and because it is not glamorous, millions of people overlook it while searching for a more exciting answer. The more exciting answer usually costs more and works less. I have never been interested in being entertained by my investments. I wanted them to be effective. That is what I hope you understand. Now, the stock market is not a mysterious casino reserved for people with expensive suits and loud opinions. It is a giant ownership exchange. Once you know what is being exchanged, the rest becomes much calmer. And calm is one of the greatest advantages an investor can have. The excited investor pays too much. The frightened investor sells too low. The calm investor sees the basket, understands the claim, and lets time do most of the work. That is the investor I would want you to become. There is one more misunderstanding that keeps beginners poor in spirit even when they are doing the right thing on paper. They believe the market should reward good behavior quickly. It often does not. A person can begin buying an index fund, keep adding every month, read less nonsense, ignore more headlines, and still watch his account fall for a while because the broad market went through one of its ordinary fits of fear. Then he thinks he did something wrong. He did not. He merely discovered that good process and short-term comfort are not the same thing. This is where dollar-cost averaging becomes psychologically useful for many people. If you add money on a regular schedule, then falling prices stop looking like a personal insult and start looking like a better entry point for the next contribution. You are no longer asking the market to make you look smart immediately. You are using the market's mood swings to gather more ownership when prices are lower and accepting fewer shares when prices are higher. Over long stretches, that habit matters more than most investors realize because it removes the dangerous question of when should I go all in. For most people, the answer is not to become a macro forecaster. The answer is to become consistent. Consistency wins because the market's great gift is that it keeps letting patient owners increase their claim on productive assets. That claim can be reinvested too, if a company pays dividends and you do not need the cash today. Reinvesting those dividends lets ownership quietly build ownership. That is one of the loveliest machines in all of finance money. From businesses buys more pieces of businesses, which then create more cash and more value over time. People want investing to feel exciting. I want it to feel inevitable. That is a very different preference. I have watched too many people turn a perfectly sensible long-term wealth plan into a drama because they could not resist checking every headline and reacting to every twitch. The market fell. They worried the market rose too fast. They got greedy. A commentator said recession. They delayed. Another said soft landing. They rushed back in. That is not investing. That is letting strangers rent space in your nervous system. A beginner who understands what a company is, what a stock is, what a bond is, how the market actually functions, and why broad index ownership works already knows far more than the public usually needs to build substantial wealth. The remaining challenge is not intellectual, it is behavioral. Can you keep doing the sensible thing when the crowd is noisy? Can you remain calm when prices fall? Can you keep buying when the headlines feel dramatic? Can you stay humble enough to prefer the broad productive machine over your own desire to feel brilliant? If you can do that, the stock market becomes much less of a mystery and much more of a partner. That is all I ever wanted from it.